Today is June 1st, year 2019, and this is Mijanor Raman from Toronto. As usual, the second part of the video series, financial planning, the tacit knowledge for financial planning, and this was with the entrepreneurship video series number 2, and this is possibly video number 4 or 5. Now, this video series especially focuses on the mid-sized to large corporations, and my first few videos really talks about a bit of broader mind about technology and the destructive part of it. Where can this destructive technology could lead us to, where this can take us to. Now, keeping that in mind, we do have to plan at somewhere. Now, depending on the business. So now let's assume in my first book, Financial Freedom, a fictional financial plan, I had, the book was a bit about the, mostly about the professional corporation meets a small to medium-sized business, and it mostly dealt with the personal financial side of it, and the corporation integration of personal and the professional corporation, the owner of the professional corporation, their tax planning, their investment planning, and the comprehensive financial planning for the professionals like doctors, dentists, architects, any other professions that actually fully depend on the self-employment structure, or they earn income through self-employment, or through commission, or not salary, not a regular method of salary earning. Anyway. Now, the second part of the Tacit Knowledge video series, it deals with the large corporation to mid-size to large. And at some point, we're going to run into a problem. You'll see the accounting statements of these corporations. For the mid-size or large corporation, you will see the first section of the balance sheet, you will see the asset part, right? And the second part of it, you'd see liability and shareholders' equity. Now, the asset, it's very straightforward, but as you move towards the liability and the shareholders' equity section, it gets slightly complicated, and there's a lot of notes disclosure that as a corporation you would have to provide that to the readers of your financial statements. And the IFRS is completely very careful about the very discreet and very open, very accepting towards the, very accommodating towards the providing for the notes disclosure to the readers of the financial statements. Now, remember I said on my first book, the end users are always at stake. So now, who are your end users as a company? Now, most often it is your client. If you're into manufacturing business, it might be your client. If you're in a retail large business, it would be your consumers. Or if it is service industry, it could be a computer company. It could be, for example, a technological company, a cell phone company, a cell phone manufacturing company. Or it could be service provider of the cell phone, or it could be a technology could be a company like Bombardier who makes aircraft, or it could be anything, the service side of it, that provides both the service and the product as well. Hybrid companies. Now, on the balance sheet, you'll see the liability gets more complex. One of the problems this mid-sized company run into after a certain number of years in the operation, they would want to expand the revenue. Their revenue needs to be grown. It needs to continuously be improved. The revenue, the earnings has to grow. The external earning, right, has to be really at a larger stake, right, than the internal growth. So often don't quote me on it, but often the internal growth and the external growth of the company. Now, I want to get into the growth side of the company, rather make it very simple. So let's say the revenue has to be in a growing trend, so that the profit and also your expense can be at an optimal level, right? There's a saying that if you don't spend, then you cannot possibly earn something. So to run an operation, you'd have to spend something to towards that earnings, right? So now that earnings, right? That earnings that expense account has to be justified to earn that income, right? So if you're earning $50 and just to give an example, and or $50 million, and you're spending $40 million or $60 million, and leaves you very little bit of profit, market, or loss, right? So that may not be an optimal level of expenditure, right? So often this mid-sized company, they would have a problem with the operating side of the business because they're growing, right? Often their internal growth might be larger than the external growth, or their revenue could be slightly at the very first 5 to 10 years, the revenue might be, or could be 3 years, first 3 years, the revenue could be, or the revenue could be really low, especially if you go to research and development side of the industry, where you'd see the revenues are really low. They have a lot of financing debt. Those are the company often becomes an issue towards the investing decision that you have to make before you make if you're an investor. So you would have to make a right decision whether the company has the right prototypes of. At some point, I will probably in my second book for the financial planning. It's called Financial Freedom. Entrepreneurship, and in that book, I am going to address the IPOs, the initial public offerings, and the how they actually the readers of that financial statement, so how they perceive and what they really look at. We'll probably go through the forms, the Security Exchange, the Commission's SEC for the US. You'll see that they would have different whole bunch of forms they fill out, right? They provide financial statements, no disclosures, the governing of the corporations, and so many things that you'd come across. But before we get there, I want to address something that these mid-sized corporations, they have problems. They face a lot of problems. And one of the problems is actually financing the corporation, right? And how they optimally finance this corporation so that the revenue, the expense, the cost of borrowing is actually at an optimal level, right? And this is the biggest challenge nowadays in the market. The cost of borrowing, the capital, the cost of borrowing or financing a project is becoming an issue, right? So they want to be profitable. So if you see if we look at the clothing industry in Canada, they went through a major change from they because of the need they diverted their operation from Canada to China or Cambodia or Vietnam or Bangladesh or Pakistan, India, South America, Brazil, and so forth, so many other places, right? So they had to survive, right? They had to utilize they wanted to make sure that the operation is profitable, right? There may have been there might be other incentives of going there, even though the Canadian government or there were other incentives to operating operation or having a manufacturing company in Canada, right? So, but often they drift away from that. Now, at some point, also this is my personal experience. At some point, I also noticed is that in China, at some point, the industry, it's suppress or the cost, the operation cost, the cost for the operation or operating a manufacturing company in China was becoming more expensive, and as a result, you'd see that because of it was getting more expensive. Often they're diverting, and often you'll see when it comes to international politics and economics, you'll see there's a lot of quota system, lot of restrictions, lot of the foreign exchange. Every parameters comes to a big play. You'd have to make a right decision to open an operation into a different country, and by using an optimal, assuming that you have you have a higher cost to borrow the capital, but you want to reduce your operation cost going into another country. But you also have to keep in mind, this was the issue, this was one of the major facts in manufacturing garments industry, that their cost of borrowing was slightly higher, and they were offsetting that going into third world countries, producing, even often a lot of chemical companies, they're actually offshoring their business. Even actually, if you see a lot of large corporations nowadays, technological corporations, they also outsource, but they maintain some quality, very strong quality, the production quality. But let's not get to the quality side of it, but rather have the discussion of cost-effective business and cost-effective financing, optimal debt financing, or optimal the cost of borrowing capital, right? How do we really grow a company? Where it's, where are you gonna go? You have mid-sized company running into, for example, a company ABC is running, is born in Canada and developed, $100 million revenue. It's a very small number given the, global, global view, but they want to grow their business, and they would have to go outside of Canada, or they want to make a decision where they want to go with where the market the niche market for their product, where the customers are, right? So you'd have to make that decision. The oil, gasoline plays a big role in any industry, any manufacturing company, any industry where that requires the raw material, right? And that the raw materials, the fuel is becoming a big challenge, right? Because of the quota system, because of the various restrictions, various policies that are placed to control the pricing, to control the production, to become the profitable, the sustain the economy, sustain the environment, right? So there's a lot of things there. So like I said, a large corporation, a mid-sized corporation needs a lot of expertise on the board, on table. And you will see when you become a financial planner for these corporations, now your job, you could probably, if you're a financial planner for a large corporation, you probably by nature an accountant, or you could have the accounting finance background. You would have your investment side of it. You would have the risk hedging strategy, insurance license, so many things. You would also have law designations and so forth. You probably have certifications in law. You might be you might have accounting finance background. You might have financial planning background. You might have legal background, a legal degree, perhaps a JD or LLM, or you might have a CA, CPA, you might have the CIM. There's a lot of designations, or you might be a CFA or CFP, certified financial planner, whatever the nature is. But at the end of the day, you would have to make the right decision for your client. And the right decision is that the understanding the financial statements, and that's the key point, where they're running short, where there's a problem with their financial statements, what gives them the creep, what gives them the insecurities in their heart, where the management really struggling. You'd have to see through that, right? So often the corporations, they would hire advisors to guide them through. They would have a board of directors. They would have outsource their accounting department, outsource their financing department. They would have legal advisors. But you might also work as a consultant for a corporation, and where you might probably say, well, you can also, there are consultants. They actually fully help corporations to grow through capital restructuring, or probably capital financing, or helping them to gather capital, or cost, or reduction of the cost of borrowing, restructuring, margin, and so forth, right? So you would have a lot of areas. You could become a consultant, or you could become their accountant, or advisors, whatever you call yourself. Whatever your designation you put yourself, or you could call their corporate lawyer, whatever you wanted to call yourself. It really, at the end of the day, it boils down, you really have to understand their operation very well, and their financing, the liability, and how the capitals are raised. So which is the liability and the shareholders' equity. Now this is the very, very important sector of a financial statement for a mid-sized to large corporation that is about to go to public, or wanted to finance, or want to restructure that debt, or want to merge because of the strain, because of the challenges that industry is facing, or there might be synergy that produces merging from two companies or three companies together. There might be, often you'd see there's a buyover between insurance companies. Often you'd see a bank buys another bank. Right? Often you'd see that the bank, they merge together, right? Securities companies, trust companies, and you'll see there's a lot of laddering, a lot of layering, a lot of merging and mergers and acquisitions in this financial industry. But at the end of the day, this is all happening for one good reason, one important reason, and that is to raise the capital, at an optimal cost, at a really reasonable price, so that they could grow, efficiently, they could grow their company, they could extend their operations, they could grow with a lot of strength, a lot of flexibility in their decision making. So if your cost of borrowing is really high, then you're going to have a problem with the competitions, right? So if your cost of borrowing is really high, then the product cost is going to be higher. So let's say if you're producing a vacuum machine, so let's say for example, or for example, it could be a board like this, or it could be a chair or table, whatever you're producing. if your cost of borrowing is really high, or the cost of raising the capital is really high, then you're going to have a problem specifically for that project, right? So then you'd have your a lot of returns, a lot of number crunching. You're going to go through that, but at the end of the day, the bottom line is that you need to produce a product at an optimal, at a competitive cost, at a competitive price, right? That's where you need a competitive pricing, and that's the key point. If you're not coming up with the right product at the right price, then it's most likely you would probably gonna have a going concern issue, and often the big investors, they would see through, and often when it's gonna, and one of my expertise coming from the certain business industry is buying liquidated stuff, buying something at a lower cost. So as an investor, my mind is different than the others, right? So, or as a businessman, my viewpoint is buying at a very, very low cost, right? And often you see portfolio managers, they would buy liquidated investment, but they would have to do their homework, whether that liquidated company or the company is about to go bankrupt, or buying a piece of a corporation, discontinued operation from another corporation, whether it's worthwhile, right? They would have to make the decision. But these are discontinued, these are liquidated investments. Your cost could be, about 10 cents a dollar, and you could probably earn a great profit, right? But you'd have to do your homework. You'd have to have a good team in place to run that operation, to restructure it, to get a whole different look. But the idea is that your product cost has to be an optimal level to be sustainable in the long run or in the short run, at any market, at any equilibrium point. So if you're below the equilibrium, depending on the, if your cost is below the equilibrium level, or a certain, maybe I should say that if your cost is the average market price, lesser than the average cost of the same product in the market. So the average cost of your vacuum machine is $50 in the market, but if your cost is $40, right, then you're profitable. But if your cost is higher than that average market value, what the equilibrium, what the market equilibrium is, if it is higher, if your cost is $60, now you're gonna have a lesser profit, lesser revenue. I mean, because your cost is higher, you'd have to make profit to pay off that debt, or to maintain the required rate of return for your project, right? To earn the return, you may have promised, you may have financed that product through debt financing, through bond, or through so many kinds of financing, or probably capital, issuing stock or bonds, but whatever the nature is, however way you produce that, whatever financing scope was used to produce that product, you need to keep your costs down at all level. Now why talking about it? So you're gonna see that so you need to understand the operation. So first thing I look at in a corporation, the balance sheet, what the liability looks like, what's the shareholders' equity look like. So I was actually analyzing an IPO, actually quite a few of them, and one of them I noticed something, a corporation in the United States, they were rejected by the I believe it was the Security Exchange Commission for the anyway, there were the forms that I don't have the paperwork here, but obviously it's going to be my second book. Part of it is there. So, but second book for the financial freedom, the entrepreneurship. So part of that discusses the IPOs and capital raising, and you're going to see that the this particular corporation was rejected because they couldn't, their operation was suffering, right? So they had a lot of shareholders' equity. There's less liability. The assets are there, but the revenue wasn't really there. The profit margin wasn't really there. They had a lot of capital sitting there, a lot of shareholders' equities, but it's sufficient, but they weren't approved to go to public, right? So to raise fund through the selling their stock on the in the public market, on the publicly traded by going public, or by trading publicly. So they couldn't get that, right? They couldn't have the financial statements. They couldn't have the corporations approved. So you see there are so many of those. Often you could probably see this in the medical industry, that I've seen corporations that produce prototypes of different formulas or medical treatments or capsules or therapeutic products, right? And different services. But the problem they run into is that this research and development company, they spend a lot of money. They raise a lot of money through the IPO selling, but when you see the product line, so you have to see who is actually in the research team. So your skills comes to play of understanding who is actually running this mind, who are the where their value comes from, right? Will this company be able to come up with the final product? If they can't, then you probably, as an investor, if you're investing to that company, and if you are the financial planner or the auditing firm for this particular corporation, or probably the accounting advisors, or it could be the financial guy for this, or could be the lawyer for this corporation, you're gonna have to see through that whether the product will be successful before you take this company to the public, right? Because you might be also liable to a certain degree of not understanding, because at the end of the day, your due diligence your due diligence really not only towards the corporation, the hiring company, you also owe a due diligence to public, right? So let's say, for example, if you're an auditor, then you would have to issue an independent auditing report, right? So it has to be non-qualified auditing report, or it could be some sort of opinionated. There might be some opinion, could be qualified, but in whatever the scope is, you'd have to do your best to make sure that the opinion that you're providing to that particular financial statements, that your work is reliable. The investors can rely on your work. And if you're the investor, if you're selling there, well, that comes a lot later. But the company actually go through a lot of planning, a lot of planning mechanism to get to a step where they need, before they walk through before they file those forms through to the Security Exchange Commissions, or I don't remember, top of my head, I don't have any books here. I don't have any notebooks here. I don't have any pens here. Actually, I do have the pens in my bag, but I don't have them in my pocket. But it's everything I'm speaking as from my knowledge, and so. But like I said, these are the things that you're gonna run into. That if you're an investor, if you're selling this company's securities or their stock, then you'd have to be very, very careful about understanding the financial statements, understanding this auditing report. So my first book actually really talks about the financial freedom of fiction or financial plan. If you are the investment advisor, if you are the financial planner for this, then you really need to read that book, because it's really amazing. Maybe I'm bragging a little bit. Excuse me for that. Maybe I should have bragged. But if you feel that my books, my opinions bring some value for you to understand the financial statements, please feel free to read it. It's really reasonably priced as well. I'm not trying to market the book here, but or you could, simply analyze the financial statements and go through this, the what are the shenanigans they put the into the financial statements, right? Because everyone is actually, before the company goes to public, these, professionals really work for the corporation they were hired. They owe this as a professional, they have a duty of care to public, right? But they also have, an interest taking this company to the next level. So sometimes you'd have to keep your eye open for this. If you're a securities advisor, or probably, investment advisor, or probably financial planner, if you have CFP or CFA, whatever, issue the case is, or CIM, whatever the case is, you'd have to see that, where the shenanigan lies, right? So you should be able to read that, just even before you even get to the notes disclosures, by looking at the numbers, the ratios, you should be able to foresee that, where the problem is, where their shenanigans comes from. Now, this is where the value comes from, right? So where the shenanigans, where the hiding, where the loopholes are, where the problems are, right? So if we could find a problem, then we could see, well, is it worth buying it, or is it worth actually negotiating it, right? So often you'll see a lot of company goes to public and they become a victim of hostile buyover, right? Hostile takeover. So that because the underwriter of the IPOs, whoever actually underwrite the product or the securities, they really didn't do their due diligence really, effectively. As a result, the IPO may have overpriced or underpriced, or whatever the cost is, it wasn't properly priced, or there might be significant flaw that came out shortly after the IPOs were approved. This can happen at any time, but also there's a lot to deal with the market psychology. But at some point, this market psychology will stop playing, but rather your success, your planning, your foreseeability to take the company to a next level, your vision, your mission, your decision-making ability, your understanding your business will become actually the punch point, the key stroking, the stroking points, or the outline or the headlines of your vision. It becomes a vision. This is what people see. So let's have an example. I didn't want to take a big corporation name because I want it to be as neutral as possible. When you're buying an Apple product, you're really seeing their vision, where they're taking the company to, right? The company started off with a very simple cell phone, very simple, Mac computer, or it's been a long time they're in the market. But if you can see their vision is where they're leading us to, where they're taking us to. They're making the technology so adaptive to us. It could be, I don't want to talk, I don't want to specifically talk about Apple, but there could be other companies. There's, there are so many, LG, there, what else, Samsung, and so forth. There's so many of those, but I don't want to take one particular, and you can also go back to look at the BlackBerry, and I wanted to, for some reason, they are actually, as you can see, the destructive part of the technology, right? How people are suffering, who could be that, whoever foresee what the need, what's going to happen, right? They should be able to see the product. They should be able to produce a product, right? That has the demand, that has the ability to survive in the market, that has the ability to, meet the expectations of their client or customers, right? Now, once upon a time, the BlackBerry was a giant for I don't want to bring up this name, but they were really, really great in the security side of the business, and it was amazing that, so is the other companies as well, but without taking their names. But I wanted to point this out, that you should be able to see that as a financial planner or investment advisor, or the underwriter for this product, or the IPOs, or whatever you're doing for this, or auditor, whatever you're doing, you should be able to see through the financial statements, as you can see through, as I'm speaking to you. maybe I shouldn't, again, I don't want to get into a bragging point, but I think we all have to see it very clearly, a clear picture, right? A clear vision, that I can see through what's in front of me, right? I can see these are my hands. I can see how many fingers that I can see my hands are very, it's very clear, vivid, right? You should be able to see financial statements in a simple second, that in just without even, before you get to the notes, obviously you'd have to read the notes disclosure. That's where the main things happening. That's where all those nitty-gritties are. That's where all those shenanigans taking place. But before you get to there, you'd have to have the idea about this company, right? So you'd have to really understand the underlying objective of this corporation, the mission and vision. Where are they going from here? That's the first video I made. Where are you going? Who are your end users? What are you taking your company to? Who are you selling to? What you are selling to them, right? And that's the key point. And whatever you are doing, whatever professional you are, it could be a lawyer, it could be a financial planner, as mentioned, it could be an underwriter, it could be an auditor, it could be an external auditor, it could be an internal auditor, it could be anybody, it could be any professional, it could be even the risk, not the adjuster, it could be the actuary, it could be so many things, it could be any profession that's that brings the value to these corporations, to this corporation that is about to go public or need to raise the capital, or if you're buying for your investor, right? If you're representing an institution who actually invest money, or it could be a portfolio manager in a mutual fund. It could be it could be a large investment advisor, or very with a very big ability to purchase power, right? The purchasing power. Now, if you have this purchasing power, you should be able to see through where the opportunities are. Now, every one of us would have a different viewpoint. We would have, each of us, depending on our goal, depending on our profession, we each would have our own goal. As an investment advisor, as a security, as an investment advisor, you probably have a goal to buy at a lower cost for your client. As an underwriter for an IPO or whatever the product is, your goal is to ensure that the product is priced correctly. It is not overpriced, underpriced. It reflects the right value. So you'd have to do your due diligence to make sure that if you're the auditor, then you'd have to make sure that the opinion that you provided is not biased, it's independent, right? So at the end of the day, we all of us, every professional owes to someone a fiduciary duty, right? And that is the recognition. And I'm not a lawyer, and maybe I have to be very careful producing a statement on the legal side. And you'd have to excuse me if at any circumstances I have provided legal advice. You'd have to excuse me, and if you have to omit that. And I'm not a lawyer, and do not invest based on the discussion of this video. You would have to have a team of professionals on your side to understand whatever your goal is, whatever you're doing. Either you are a business owner of that large or mid-sized corporation, or you are the shareholders, or you are the manager or CEO of that corporation, or you are a mutual fund manager, or you're a portfolio manager, or you could be an institutionalized institution who actually buys wholesale investment, right? So their goal is to create opportunities, right? So or it could be